with Latino tax coach Eduardo Iniguez. We bring you a presentation on taxes, IHSS, and retirement. Please make sure to stay on mute. If you have any questions, you can go ahead and put your questions in the chat box, or you can raise your hand. And throughout the presentation, Eduardo will stop for a while just to answer some of those questions. So he'll pause the presentation and he'll answer the questions. I'm sorry. And other than that, thank you, Eduardo, for being here, and it's all yours.
Thank you very much, Mayra and Diana. I want to start off just by thanking you. Thank you, Family Focus Research Center, for inviting me to give this presentation today. Very important presentation, mainly due to the period of time we're going through is tax season. So I know there's a lot of questions out there from many of you service providers, and hopefully during this presentation, all of those questions that you still might not be so clear at the moment, so hopefully they get answered today. My name is Eduardo Iniguez. Just a little bit about myself. I'm a tax professional. I've been a tax professional for the last 8 years. I'm a certified preparer by the state of California, and I'm also authorized by the IRS to prepare tax returns on behalf of taxpayers. Also, additionally, a little bit about myself. I'm also a parent of children with disability. Here at home, we do have two boys on the autism spectrum, ages 5 and 20. So I'm with you folks. So I experience the same things that you're going through every day. So yes, I'm also a parent with children with disability, like I mentioned, and also in part because I'm inside this world, is because I'm a little bit more familiar with the IRS regulations when it comes to IHSS. Because IHSS itself has a special set of rules that apply only to this particular type of income, and it does give you a lot of benefits, mainly tax benefits, but at the same time, it also has some drawbacks. So we're going to be talking about those throughout the presentation. And as the title states, we're going to be talking about the IHSS, but keep in mind, it's going to be mainly about the financial portion of the IHSS. We're not going to be talking about, how to apply for IHSS program, how to get more hours. It's going to be about the financial part, mainly taxes. So we're going to be dealing with that part. And because like I already mentioned, IHSS has special rules when it comes to taxes. Those same rules have a direct impact over your retirement. So that's what we're going to also be talking about a little bit about retirement and what are your options when it comes to this very sensitive topic. So we're going to be talking about it over the next 2 hours. Okay, let's jump in right into the presentation. And the first thing that we're going to be talking about today is gonna be a little bit about a little timeline when it comes to IHSS in regards to taxes. So prior to 2014, IHSS was considered what we can call it regular wages. So it didn't make a difference if you work as a service provider or in a restaurant. It was the wages were considered the same. They were subject to taxations, so there was no special rules. So the big change came in 2014 when the IRS decided that wages received as a live-ins service providers were no longer going to be taxable. But at the same time, the IRS says, we're going to give you one benefit, but we want to avoid you double dipping. By that, they meant that you can no longer use your IHSS wages for purposes of tax credits. So it gave you a benefit, but it also took away another benefit. So shortly after that ruling, there was a lawsuit happened in around 2016. And long story short, the IRS lost. So the resolution that came out of that lawsuit was that the IHS's wages were still going to be considered non-taxable, but now the IRS was going to allow taxpayers to receive tax credits. So that was the outcome of the lawsuit. And finally, in 2018, the IRS came with a little bit more specific set of rules. Finally, they input it into their of the many booklets they have about instructions, the IHSS portion. So now we have a direct set of rules, like I said, more specifically, as how to proceed and report your wages on a tax return. What is the IHSS according to the IRS? According to the IRS, IHSS is just a state-run Medicaid waiver program. Keep in mind that at the IRS level, the IRS doesn't know what IHSS stand for. If you ever get on a phone call with an IRS agent and you tell them that you receive wages from IHSS, they might not know what you're talking about, because at the IRS level, they know the IHSS payments as Medicaid waiver payments, Medicare waiver payments. So if you're getting on a phone with the IRS agent, you mention Medicare waiver payments. So that way they know what are you talking about. So in order to be a participant in this program, the individual must be at least 65 years old or have a disability. This is the basic requirement for participants to be enrolled into the program. Point number three, if certain condition applies for you service providers, your IHSS wages can be 100% tax-free. So it's not automatic. You have to meet certain conditions in order for these wages to be considered tax-free. And lastly, wages are not considered earned income for tax purposes. So at the IRS level, this is like a little gray area right there. They're not considered earned income per se, but however, you may choose to include them as earned income for purposes of tax credit. I know it might sound a little bit confusing there, but that's the actual rule. That's how it's described. So in a way, it's not earned income, but in other ways, it is considered earned income. So that's why I mentioned it's a little bit of a gray area right there. Now, how can my wages be 100% tax-free? You have to meet a certain, a specific requirement. And that requirements that service provider and the recipient, the participant, they must live under the same roof. So pretty much, in another way, you have to be 24/7, living with the person in order for your wages to be 100% tax-free. And bear in mind, the IHSS wages are only tax-free for federal and state taxes only. If you look at a pay stub, which I'm going to show you in a couple of seconds, there's many deductions, many taxes that are being withheld from your pay stub. So this specific rule from the IRS, it only applies for the federal and state taxes. I'm going to show you, like I mentioned, a pay stub in a couple of seconds, so you can know what I'm talking about. Now, IHSS, on the same track, IHSS wages are not exempt from the FICA taxes. FICA taxes is a tax that you must pay in order to receive Social Security benefits. So many of you service providers are exempt from the FICA taxes, and I'm going to explain also in a couple of seconds why you're not paying the FICA tax. Now, well, I'm actually going to explain it right now. If the service provider is the spouse or the parent of the recipient, then your wages are exempt from the FICA tax. So I think it's going to make more sense once I show you the pay stub. Well, actually, I'm jumping ahead here. Let me go a little bit back. Sorry, I accidentally hit the button here. Okay, so I was mentioning about the FICA taxes. There we go. FICA taxes itself, this specific tax, is not affected by the IHSS rules. So FICA tax, it applies the rules that apply directly to the FICA tax is the labor laws. So you service providers, more specifically, under the labor laws in the state of California, you are considered domestic workers. So if you, as a domestic worker, are employed by your own children or spouse, you're exempt from paying the FICA tax. So that's pretty much why in so many instances, most of you service providers don't have any deductions at all. But again, it's going to make a little bit more sense once I show you the actual pay stub. Okay, before moving on, we need to mention a very controversial form. It's called the 2298. And why is it controversial? Because there's many myths behind this particular form, and because once you fill it up, it does have a direct impact both in your paychecks that you receive every 2 weeks, and it could have a direct impact also when you file a tax return. First of all, what is the Form 2298? Form SOC 2298 is a live-in certification. If completed, if you fill it up, providers will not have any federal and state withholdings from their paychecks, and you will no longer receive a W2 form. Bear in mind that the Form 2298 doesn't determine if you can file a tax return or not. One of the biggest myths that I have heard from service providers out there is that many think that once they fill out the Form 2298, that they can no longer do taxes. At least that's how many service providers have explained it to me over the years, that they assume that once they fill out the Form 2298, I mean, they no longer had any tax deductions, so they assume that because they didn't have any deductions, any taxes deducted from the paychecks, that they no longer qualify to file a tax return. That's a myth. Form 2298, it has nothing to do. First of all, it has nothing to do with the IRS. It's not an IRS form. It's an IHSS form. So so just keep that in mind. It does Form 2298. It doesn't determine if you can file a tax return or not. It only has a direct impact in your paycheck. For those of you who are not familiar with Form 2298, this is it. This is the form. This is pretty much just the top portion of it. Um, this form is completely optional for you to fill it out. You don't have to. But if you decide to fill it up, it's pretty straightforward, very simple. You just need to provide your name, the recipient name, the case number, your county where you reside, um, and just mail it in. Usually at the bottom of this form, it will show you the address where you can mail it in. And usually it takes about 30 days to be processed. So once you fill it in, again, this is a live-in certification, especially for those who are brand new into this program. Once you fill it in, you will notice a difference in your paycheck. You will no longer have deductions, at least the federal taxes and the state taxes. So that's the direct impact that this form has. It only has a direct impact for the main part. It only has a direct impact over your paycheck. Speaking of which, this is the pay stub that you folks receive um, biweekly. As I was mentioning earlier, this section right here is the section where you have all the deductions, mainly various types of taxes. As I was explaining, the IHSS rules, when they are applied, it would only have an impact over these two taxes right here that you see, the federal and the state taxes. So once you fill out the Form 2298, you will no longer have federal and state withholdings. So this, so pretty much you will be able to keep more money on every paycheck that you receive. These other taxes right here, FICA, Medicare, and SDI, they're not affected by the Form 2298. As I was mentioning previously, it's another it's a whole another set of rules for FICA taxes. Um, Again, you folks, service providers, you are considered domestic workers. If you're employed, if by your own spouse or your own children, you're exempt from paying these taxes as well. So the pay stub that you're seeing right here, it actually belongs to a mother who cares for her own son. So applying these two concepts here, the IHSS rules and the um, domestic worker exemption, she no longer has any deductions here. So that's why it shows completely zero on this entire column. If this were for example, a sibling, like older brother taking care of the younger brother, then the brother will have withholdings for the FICA, Medicare, and SDI taxes. So I think you got an idea now of why some of you receive your paychecks completely with zero deductions. Is two completely different set of rules that apply to your paychecks. So most of you, the great majority of you, is parents taking care of their own children. So that's why you have zero deductions. And just to go over a little bit here, what these taxes mean. FICA is pretty much the Social Security tax. So if you don't pay FICA taxes, you don't get what is called Social Security credits. We're gonna talk about Social Security credits and later on in the presentations, but I'm just getting a head start right here. So again, if you're not paying the FICA tax, you're not contributed to your own Social Security benefits. Medicare. Medicare is pretty much health insurance for once you turn 65. Same concept as with the FICA. If you're not paying the tax, you won't qualify to receive Medicare when you turn 65. And SDI, this is a state tax. SDI stands for State Disability Insurance. It mainly provides you with two benefits, one of them being the disability insurance. So if for some reason you get injured, you become sick, you can no longer work, you can apply for the state disability insurance. That's one of the benefits. The other benefits is called the paid family leave. Paid family leave, it's mainly used by mothers who just gave birth, uh, so they're allowed to take up to 8 weeks from their job to take care of their newly born. But also, pay family leave also applies if you have like any relative, could be your spouse, your own children, your own parents. If they become sick and you need to take time off from work to take care for them, um, yes, you can apply for the pay family leave. And again, same concept with the FICA and Medicare. If you're not paying SDI, you're not getting the benefit as well. When it comes to FICA taxes, the bad news is that even if you want to pay it, you will not be allowed to pay to pay this tax. Unfortunately, the law doesn't allow you to do it, even if you voluntarily want to pay for it. So I will give you a couple of strategies later on in the presentation of what you can do in order to be contributing to your Social Security benefits. When it comes to the SDI, if you're exempt right now, and you can voluntarily pay for it. So if you want to have at least the state disability insurance in the paid family leave, you can contact the state agency. It's called the EDD, and you can apply for it. And they will have deduction, and they will have the taxes being deducted from your paycheck once you're being approved. Okay, so and just that was just a little overview about the specific three taxes that you're seeing right there. So I'm gonna show you the two possible scenarios, and we're still with the on the topic of the Form 2298. So what will happen if you don't have the self-certification? If you haven't filled out the form, or if you have decided to just not fill it up at all. So during the tax year, what's going to happen to your paycheck? You will have federal and state withholdings from your paycheck. They will continue to have those deductions, and you will also, at the end of the year, you will receive a W-2 forms to present or to file your yearly tax return. Uh, and when it comes to your tax returns, all of those federal and state withholdings, they will be refunded to you. So, and the reason they will be refunded to you is because you're exempt from federal taxes. So that money needs to be refunded to you. And additionally, you could still potentially qualify to receive a tax credit if you meet the requirements. We're going to talk about the tax credit in a second as well. If you meet the requirements, so you can also receive a tax credit. So your actual refund in some cases is considerably high for some service providers who have not filled up the self-certification. On the other hand, for those of you who already fill out the self-certification, the impact directly on your paycheck will be that you will no longer have any federal and state withholdings. So your paycheck will look exactly as the one that I showed, zero deductions. But additionally, you will no longer receive a W-2 form. This is the reason you don't receive it is because at some point you fill up the self-certification. So if you ever wonder why you no longer receive a W-2, it's because you fill up the self-certification at some point. However, even if you don't receive a W-2, you can still file a tax return. Obviously, if you fill it up, you don't have any withholdings for federal and state taxes, but you can still qualify for tax credits. So technically, you can still receive a tax refund, even if you have no withholdings at all. It is still completely possible. And just to close here on the subject of the Form 2298, I have to mention that this form is completely optional for you to fill it up. Is it good or bad? It's completely up to you. So I presented to you here both scenarios, what could happen if you fill it up, and what will happen if you decide not to do so. So again, the option is completely up to you. It's not mandatory to fill it up, so it's your choice. Do I have to file a tax return? I think I partially answered the question already. But we also have two different scenarios when it comes to filing a tax return. First of all, if you receive a W-2 form, you must file a tax return. You cannot leave it out of a tax return. Why? Mainly because the IRS has a copy of it. So if you either voluntarily decide to leave it out or you just forgot to include a W-2 on your tax return, the IRS will find out. And most likely they will send you a letter asking you why you decided, why you left it out. And most of the time when the IRS asks any particular questions, it comes along with a balance due. Because typically they do what it's called, they send you out a notice of deficiency where the IRS has made corrections. So and usually those corrections are against you. It typically that's why I mentioned it typically comes with a balance due. So don't leave it out. Now, if you don't receive a W-2 form, you're not required to file a tax return. This is mainly because, well, the IRS doesn't have any record of you ever receiving that money, but at the same time, it means that you didn't have any withholdings. You didn't have any federal withholdings. So pretty much the main benefit of being a service provider for tax purposes, you're ready to receive it throughout the year, which is you had zero withholdings. So that's why you're not required to file a tax return if you don't receive a W-2 form. But even if you're not required to file a tax return, you may choose to do so to receive credits. I explained this just a few moments ago, that you still could potentially receive tax credits um, for your dependents, even if you don't have a W-2. So again, if you don't have a W-2, it's completely optional for you to file a tax return, but you may choose to do so for tax credits. If you have a W-2, you must include it. So it's kind of like mandatory. Few exceptions. If your earnings were like very low, if you're below a certain threshold, you're now required. Mainly, most of you are head of household or married people. You file married. Um, so in those cases, it's typically you're below $18,000 in wages. You might not be required to file a tax return if your only source of income is IHSS. But again, it could be also in your benefit to do so, even if you're not required. Many times I get asked the question um, by many service providers when they come up when they learn this information from me. They always ask me, Eduardo, over the years, I have always received a negative question when it comes to my taxes. I have heard over the years by many people that I'm not required or that I can't file a tax return. Why do you why are you saying that we can? Why are you so different from all the other tax preparers that I have met in the past? Well, the main reason is because the rules about how to report your IHSS income, it's it's you can find it directly in the IRS website. If you see here, it's just a little fragment of the entire rules. What you're seeing right here, you can even Google it, IRS 1040 instructions, more specifically page 24. If you see right here, the highlighted area, it specifically mentions the Medicare waiver payments. If you recall, at the beginning of the presentation, I mentioned that at the federal level, at the IRS level, they know um, they know this the IHSS program as the Medicare waiver payments. So and even right here in red, it says that you can file that you can report your wages even if you don't receive a W-2 form. So again, this is right there and at the IRS website. This is actually the IRS 1040 instructions. It's like 120 pages long, and this is pretty much the only one of the few mentions they made about Medicare waiver payments. So it's pretty easy to miss, but it's right there. You just gotta look for it. So that I think that answers the questions for many people. Um, you are allowed to file a tax return. Pretty much most of you service providers have heard the wrong information for many years, but it has always been here. It has always been here available for you. It's just that many tax preparers didn't really took the time to go over those 120 pages booklet, but it's right there. I just like to throw it out there for your reference. Um, so yeah. Now, what can happen if I don't report my W-2? Like I said, many of you folks still receive a W-2 form from your IHSS wages, and I have seen over the years that many of you, again, not um, for all the misinformation that it's out there, you have unintentionally left it out. So there are consequences. What are the consequences of leaving it out? You can receive this letter. It's called Notice of Deficiency. This particular letter, this is an actual client of mine. The IRS sent them this letter, and they were pretty much charging them or tried to collect from them almost $11,000. Why they were trying to collect this amount of money? Because of this. You see the two arrows pointing down there? It says IHSS recipient form W-2. So like I mentioned, the IRS has a copy of your W-2, so don't leave it out, because you can see up here on the blue highlighted area, it shows this is actually a married couple. on the original return, they only reported the husband's income, and they left out the IHSS W2. So the IRS went ahead and corrected, and when they corrected it, they pretty much took away all the credits that they received. And on top of that, they added penalties, interest to this newly balanced due. And the reason they assumed that you didn't qualify for these credits, the reason they were asking it back is because also even though on their system it shows that you are an IHSS provider, they don't know that you qualify for the exemption. Within the tax return, you have to add like a little code. I'm also going to be showing that and later on in the presentation, and where exactly you need to input it to avoid having this kind of problems. So the IRS doesn't know that you qualify for the exemption. We need to tell them inside the tax return. How can I report my IHSS wages if I don't receive a W-2 form? Like I mentioned previously, you're allowed to report a tax return even if you don't receive a W-2 form. The way you report it is that you're going to use the last pay stub you receive in the year. For most of you, a service provider, the last pay stub that you receive in the year is the one that shows the service period from December 1st to December 15th. And you're going to use the total gross income. You do not use the net pay. Net pay is pretty much after deductions. So you have to report the gross income. Going back to the service period, I know most of you do receive your payments on time, but it also does happen that for some reason there's delays. And in this particular service period, as you can see, process date, it still shows a December 16. So you still got paid during December. If it has shown here that you got paid in January, then we will have to use the pay stub from November. So you just gotta make sure that what is the date that you actually receive your pay stub, your paycheck. Um, and another important thing to keep in mind is like when you file a tax return, you have to include the entire amount. It cannot be partially. The IRS is also very specific on that matter. If you're going to report your wages, it has to be all of it. It cannot be partially. What credits can I receive? There's two main credits that you can receive once if you have dependents, and once you file your tax return. The main one of the biggest credits that are out there, it's called the earned income credit. The earned income credit, the amount that you can receive, it varies by each individual. It varies mainly on your finance status, your actual income, and the number of dependents that you have. For example, the one right here, if you have one dependent, you can receive up to 3,618. That's the maximum that you can receive. But like I mentioned, it completely depends on other factors like your income. If your income is still is getting higher and higher, then this credit is going to get lower and lower to the point that it will completely disappear if you go beyond certain threshold. The thresholds, it varies by individual, and it varies by your marital status, number of dependents, and your actual income. So this is the maximum amounts that you can receive. Depending on the number of dependents that you have. You can get up to 6,728 if you have 3 dependents or more. So this is the earned income credit. The second one is called the child tax credit. For 2021, the rule was modified for only for 2021. The previous rule says that you could receive up to $2,000 per dependent who are 17 or younger. So that was prior to the pandemic. During the pandemic, mainly 2021, that credit actually was increased to either 3,000 or 3,600. It also the actual amount depend on the ages of your dependents. For example, if you had dependents between the ages of 0 to 5, you will receive a credit in the amount of 3,600. If you had dependent between the ages of 6 and 17, then you will receive a credit in the amount of 3,000 per dependent within that age range. Also, the way it worked, also one of the modifications for this credit is that half of the credit you will receive it. You were supposed to receive it in monthly payments from July to December of last year. For example, let's assume you had only one dependent between the ages, uh, uh, let's 8 years old. 8 years old, so you will qualify for $3,000. Out of that $3,000, half of it, 1,500, you were supposed to receive it in monthly payments. If we do the math, 1,500 divided by 6 is $250 in monthly payments. So if you're ever wondering why you receive those monthly payments, it comes directly from your tax return. They were just you receive an advance of your actual refund. So that's where it came from. If you didn't receive any of those monthly payments, uh, you can claim that money also by filing a tax return. One of the good things about this year's taxes is that for the child tax credit, you don't have to have any income at all. So you can just file a tax return completely in zero. And if you have any dependents, you will receive the entire credits for it. So that's one of the good things about the modifications that were made. And again, it was only for 2021. So we're going next year, unless Congress decides to do something about it, most likely we're going to go back to the old rule, which was that you could get up to $2,000 per dependent, and yeah, there will be no more monthly payments as it was in 2021. Now, I'm going to show you right here how your tax return should look if you have IHSS income in combination of another source of income. It mainly happens like with couples. Um, we call that mixed incomes. So so IHSS income plus wages from another job. So typically the way it works, uh, on a tax return on line number one, you're pretty much going to report the entire amount, the combination of your regular wages from your part-time job or full-time job, and plus the IHSS wages. So you're gonna combine both of them, and then later down on the a couple of lines down, we're gonna do what is called an adjustment to income. So we need to exclude the IHSS portion. So basically, you need to have a negative number in there. That negative number is going to reflect your actual wages from IHSS, and by having a negative number, it will tell the software that we're using to exclude that portion from taxes. Um, so if you see a tax return and you have a combination of income, if you don't see a negative number in there, uh, that's a good indicator that your taxes were reported incorrectly and that most likely you pay taxes on the portion of your IHSS wages which you weren't supposed to. So if that's the case, the most recommended course of action is to file an amendment to correct the misclassification of your income, so you could so you could get back the money that you pay in taxes. So this is one way to check if your taxes were filed correctly. And for those of you who have just one source of income, mainly IHSS, so the way it should look is pretty much line number one, it should reflect your entire income. That same number should show up as a negative number down here on line number 8. And under total income, line number 9, it should show as 0. So those of you who only have IHSS as your only source of income, that's pretty much the way it should look. The other way to tell if your tax return was prepared correctly is you need to have this form. You need to have Schedule 1. This form is where we do adjustment to income. So on this form is where you report your actual wages. If we go back on this to this form over here, this negative number that you see here on line number 8, It came from this form. It came from Schedule 1. In Schedule 1, number 8, letter Z, you're gonna see this little note right there. Notice 2014-7. That's pretty much the note or the code that tells the IRS that you are a live-in service provider and that you qualify for the tax exemption. That's pretty much the code that needs to be added to your tax return, and that's how the IRS will know that you don't need to pay taxes on that portion of your income. And just here to the side, to the right, your entire income should be reported as a negative number. It must be a negative number, otherwise it will count as an addition, which translates to you having to pay taxes over that portion of your income. So it needs to be a negative number. Keep in mind here that what I'm showing you, when you're showing you here on your screen right now, this is the end result. If you're one of those people who usually file your own tax return, you gotta be a little bit cautious when you're inputting this information into the software, because there's a couple of steps that you need to follow. Well, for mainly liability purposes, I cannot guide you through as how to tell you exactly which button to press on the software. I can't tell you that, mainly because also I don't use a consumer based software program. I use a professional program to do tax returns. So just keep in mind that there's additional steps that you need to follow in order to get this result. It looks pretty simple. It just, for most of you might be thinking, oh, it's just a form. I just need to, it's just a Schedule 1. I need to add the little note, the number here in negative. It looks easy. Uh, it looks easy, but again, there is a process that you need to follow through, and there's also additional steps to decide whether you want to include this income as earn income for purposes of the tax credit. So there's more steps to it. So just be cautious if you're one of those people who file their own taxes. Is So yeah, just take your precautions. Common mistakes. The most common mistakes is that your wages are reported as regular income. When your IHSS wages are reported as regular income, your wages will now then be subject to taxes, which, first of all, you're not supposed to pay any taxes if you qualify for the exemption. So you gotta watch out for that. If you report your income as regular income, that will translate as your refund being lower, or it will generate a balance due. As a general rule, if your only source of income comes from IHSS, from being a service provider, the worst case scenario for you when you file a tax return is that you have zero, that is completely in zero. You won't have a balance due, but you won't also get a refund. So that's the worst case scenario for you if your only source of income it comes from IHSS. So just if you have mixed income, well, that result will be a little bit different. Uh, Number two, IHS's wages reported on a W2 were left out of the tax return. I already showed you the consequences, that the possible outcomes, and that's pretty much like, if you leave it out, that's an automatic red flag for the IRS, and you will be at risk of receiving a letter of deficiency or an actual audit. And again, an audit is a very stressful situation, because well, on either letter, if you receive a letter of deficiency or an actual audit, as soon as you're receiving the time, the clocks starts ticking. So you need to act pretty fast, and that's also one of the most common errors that many people do when they receive this kind of letters. They kind of want to pretend to ignore these letters. They think that the IRS might forget about it, but trust me, they don't forget about it. They will eventually send you more and more letters up to the point where they will start garnishing your wages. So it's very, very important that if you receive one of these letters, letter of deficiency or an actual audit, that you act quickly, because typically you only have 30 days to respond. So you need to respond quickly. how to fix mistakes on a tax return. Uh, the process itself is called an amendment. You need to file an amendment to correct the errors that were made on your original tax return. So that's the most typical solution to this to this kind of problem. And typically you have 3 years. There's a 3-year rule to file an amendment, and the 3-year rules applies for to claim any credits that you failed to claim or originally. So technically, you can still go beyond 3 years. Uh, but if, for example, the furthest back you can go back to make corrections and receive credits that you originally didn't receive is 2018. That's the furthest back you can go to receive the credits. For tax returns that are 2017 or older, if you had any credits that you didn't claim on any of those for any of those years, unfortunately, the statute of limitation has been reached, so you can no longer receive those credits. So you can only receive credits for tax returns that were filed incorrectly for 2018. That's the furthest back you can go. So you can do 2019, 2020, or even this year if you already filed. Okay, I'm gonna make a little parenthesis right here to start taking some questions from many of the audience. So you have any questions, we can go ahead and answer them right now. Mayra and Diana?
So if you have any questions, you can raise your hand. And I don't see any. Do you see any, Diana? If not,
No, but yes, you can raise your hand and then we can turn on your mic to allow you to speak.
Okay.
You do have any
So-
questions at this time? Or Myra,
go
you want to
ahead and,
read the question that we did have in the chat?
Yeah, so this question came up when you were talking about the FICA and Medicare and SDI. It says, what about if the provider is the parent for an adult child, or in the case of a person providing services to an elderly parent, would the provider be able to make contributions?
Well, again, the only ones that are exempt from these 3 types of taxes are if you as a service provider are taking care of your own children or your spouse, then you're exempt from paying these taxes. So if you're taking care of any other person, it could be your own parents, it could be a sibling, or it can be a completely unrelated person, then you will be subject to the FICA taxes and the Medicare tax and the SDI.
Okay, that one was the only question on the chat.
Okay.
Linda, did that answer your question?
My question is specifically for contributions to federal and state taxes.
Okay.
So would then the provider be subject to making contributions to federal and state taxes?
Okay, for federal and state taxes, if you're a live-in, so if you live with the participant, it doesn't matter who you're taking care of. As long as you're living with the participant, then you will be exempt from the federal and state taxes.
Even if they are adults?
Yes, it doesn't matter who they are. It doesn't matter how old they are. As long as you're living with them, you're exempt from federal and state taxes.
Thank you.
You're welcome.
We also have a question from Claudia. Claudia, you can go ahead and ask your question.
Hi, Eduardo.
Hello.
My question is that I actually did have to file an amended return because the tax preparer originally had told me that since I didn't have anything in that line, line box 1 and 2, that I didn't qualify for anything. So we did go ahead and file the amendment, and I did. I sent them kind of like a guideline of having to do the steps that you just told us right now, where you have to enter the original amount and then also make sure you enter it as a subtract, like subtract the same amount. But I'm looking at my amended return right now, And even though they did tell me that that's what they were doing when they were preparing it, I don't see any negatives on the form.
Mhm. Okay, so this is where, well, I may mention to those where what I was telling you to be cautious if you're filing your own tax return, but it also
Mhm.
applies for people because this happened very often. A lot of people many times see my presentations and they take the instructions to the tax preparer so they can file them correctly. Unfortunately, the IHSS is not something that you can learn in 15, 20 minutes. So
Mhm.
even tax professionals, they need to take their time and do their actual research. Like I explained during the presentation, you're just seeing the end result. There is a process within the tax software that we need to take. There's a couple of steps that we need to follow in order to get this result. Also, additionally, uh, many tax preparers get confused when they see the W2 where it says box number 1, it shows a 0, but for Social Security and Medicare, it shows another number. So they get confused. They don't know what to do. And again, in that particular scenario, that's where the tax preparer needs to be familiar with the rules, because even though it shows 0 on line number 1, you can still input the entire amount that you actually receive throughout the
Mhm.
year, and then follow additional steps. So unfortunately, because I've seen this over and over for many, many years, even if you take this presentation to a tax preparer, it doesn't necessarily mean that they're going to do the thing, everything correctly. So your job as a taxpayer is to first determine if the tax preparer is familiar with Medicare waiver payments.
Mhm.
Uh, Many tax preparers, they, just to retain the most client as possible, they just say, yes, I know how to do it, when they don't really know anything about the subject. So it is your job to pretty much do a little interview them, because you're going to be paying them. I mean, it's fair that you ask questions. So you gotta ask the questions. Um, Based on what you learned so far in this presentation, you pretty much got a good sense of what the answer, what the tax preparer should be responding. So you should ask him, are you familiar with the Medicare waiver payments? Are you
Mhm.
aware that these payments are tax-free? Are you aware that we can include these wages as earned income for credit purposes? These are the kind of questions you should ask your tax preparers. If you don't receive an answer that gives you or that convinces you that they have knowledge about this particular subject, then you have to look for somebody else. Because again, don't try. It's not your job to teach other
Right.
professionals how to do their job. They have a professional license under the state of California. They are the professionals. So it's their job to do the research. And again, they're not gonna find the answers in 15, 20 minutes. It takes longer than that. It took me years to
Okay.
to learn all of these rules and all the in and outs. So it's not again, it takes time.
Okay. Do you recommend that I go back to them and tell them that they need to re-amend the amendment?
Well,
Or
the thing is, when you did the First Amendment, is
uh-huh.
technically it means that they were supposed to correct mistakes that they were made on the
Right.
original return. So if on the corrected forms they again made the mistakes, so I think you can see a pattern here. So technically they won't be able to help you because they don't know what the problem is.
Okay.
So, because again, the if they verify the amendment, the next process is file another amendment to correct
Mhm.
the errors of the first amendment. So, if they don't know what the mistake was, they will not be
There.
able to correct it.
Okay. Okay. Thank you.
You're welcome.
We also have a question in the Q&A
Sure.
from Barbara. And it says, my only income is IHSS and I have not entered it on any of my returns. Can I go back to qualify for the EITC?
Yes, you can go as far as 2018. So, so yes, you can definitely go back for, technically it's 4 years, 2018, 19, 20, and 2021. So yes, if you qualify for the credits, go ahead and file them.
Wonderful.
Mhm.
Okay, looks like we're done with questions.
Okay. If there's no additional questions at the moment, we can go ahead and finish up the rest of the presentation and go ahead and tackle the next topic, which is mainly about retirement. As already went over during the first part of the presentation, um, you pretty much got a sense of what you need to do to receive the retirement benefits when you reach the retirement age. So you need to be contributed to the Social Security by paying what's called the FICA tax, Social Security tax. So if you're not paying this tax, it means that you will not qualify for the many benefits, including retirement, in the future. So we're gonna go over in mainly talk about the basics about how to qualify for the benefits. And the question here is, how do I qualify for Social Security retirement? More specifically, um, going back to this, the pay stub, you see the little note on the side. You must have earned income and pay FICA taxes to receive Social Security benefits. If you see on this pay stub, the person right here, it does have earned income. For tax purposes, it could be considered earned income. So that's why we had the little check right there. So you met that requirement. The problem right here is that you need to pay the FICA tax. So if you're not paying the FICA tax, you're not contributing for Social Security benefits. So it doesn't matter how much you earn over here down at the bottom. You can exaggerate a number. You can earn $1 million if you want to, but if you're not contributing, if you're not paying the FICA taxes, you're not getting any of the Social Security credits, which we're going to talk about in a second. So what are your options then? Pretty much, also as explained earlier, even if you want to pay the FICA tax out of your IHSS wages, you're not allowed to. Unfortunately, the federal rules, they don't allow you to contribute to the FICA tax voluntarily if you're exempt from it. So right there is, so we know already that from these wages you're not contributing. So your other option is mainly to pretty much get another a second source of income, get another job, be self-employed. By getting another job, in any job, pretty much, those wages will be subject to the FICA tax. So by having another source of income from another job, you will be contributing to the FICA. And in addition, you can also have your IHSS income. So you can have a combination of both. So that's pretty much. Unfortunately, you have very few options. I know some of you, because I know our children, the necessities of our children, they vary from case to case, and I personally know that. I know that some of you are not in the possibility right now to go out and just apply for any job, because I know how hard it is, and again, circumstances are different. So you can also explore the option of just being self-employed. It became very popular to be self-employed, especially during the pandemic period, because again, many big businesses pretty much closed because of the pandemic. Being self-employed, it can be as easily just as trying as selling any product online that you can think of, or you can sell, I don't know, maybe even desserts, sell cookies from your own home, and that will be considered a self-employment. So if you're a self-employed, the way you pay the FICA tax is most for the majority of the cases, you end up paying the FICA tax when you file your tax return. When you file the tax return, there's a special form that you need to fill out that is called the self-employment tax, where you will pay and contribute to the Social Security for your Social Security benefits. So those are pretty much the only two options that you have if you're currently exempt from paying the FICA tax on your IHSS wages. So let's go ahead now and look how do you earn these benefits, the Social Security benefits. Uh, I mentioned previously that there's several benefits, one of them being the retirement benefit. You also have the disability benefits. You also have the survivor benefits, and you have also what is called the spouse benefits. So we're going to focus a little bit about retirement, but we're going to be touching those other benefits as well. So how do I earn these benefits? The way you earn them, you have to accumulate throughout your life what is called 40 credits. Credits, the way you earn the credits, it's over here you can earn a maximum of 4 credits per year. That's the maximum allowable by law. So you can only earn 4 credits per year. You earn 1 credit by earning 1,510. This number applies for 2022. It typically increases every single year. For 2022, you need to earn and pay the FICA tax, 1,510. So that's how you will earn 1 credit. So if you do the math to earn the 4 credits, you will need to earn a total of $6,040 in the entire year. So that's how you earn the credits. So if we do a little bit more math here, if you're earning every year the 4 credits that are allowable per year, that's the equivalent of working 10 years. So yeah, those are the basics. So once you reach the 40 credits, you can qualify for all of the benefits that I previously mentioned. Now, how can I find out how many credits do I have? That's one of the main questions that I always receive. How can I find that? Do I contact the Social Security office? Which, yes, it is an option, but there's the fastest way to know how many credits you have is to actually create an account at the Social Security Administration website. So it's ssa.gov. So once you log into this account, you're gonna create. Once you log into this website, you're gonna create an account. So you're gonna go right here where it shows the red arrow, My Social Security. Then the following screen, I just gonna ask you to create an account. The process of creating an account, it will take you about 15 minutes to create it. Social Security uses a platform. It's called ID.me to log into their system. Many of you already have an ID.me account, but you may not recall creating one. Most of you created this account, the ID.me, when you went to the DMV. I know the DMV, if you want to log into the system and if you want to make an appointment for your driver's license or any other type of any type of appointment with them, you needed to create the ID.me. So if you already created the ID.me account with the DMV, you're going to be able to log in with no problems to Social Security website. So again, if you don't have the ID.me account yet, it's going to take you about 15 minutes because it's going to do a verification process. It literally is going to take like a video selfie where it's going to scan your face, and that's what it takes about 15 minutes. So once you're in, there's going to be your first your home screen. As you can see right there in the home screen, it's going to show you immediately how many credits you have earned so far. In this particular example, it shows you that this person has earned 36 out of the 40 work credits. Also, I forgot to mention 40 credits is the minimum, but it's also the maximum. Once you reach the 40 credits, you will no longer add up any credits. It's the minimum and the maximum at the same time. So once you reach the 40 credits, let me show you the other screen. It will show like this. It will show you that you already received the 40 credits. And on the bottom, I'm going to show you right now on the bottom of the screen, it's going to give you a little calculator. Before continuing to the next screen, also wanted to point out the other things that you can do right here on this home screen. You can replace your Social Security card. So if you lost it, or it's already, or it's just time to replace it, you can request it right here. Also, if for some reason any other agency requests you to present to them a verification letter from the Social Security that you are receiving benefits, or that you have never received any type of benefits, you can get that letter here as well. It's a verification letter stating that you have or have not received any benefits from Social Security. So there's a couple of nice tools that you can use beyond, just this little bar here that shows how many credits you have so far. So once you scroll down the screen, it will show you this little section. It's called it's a section that where you can plan for retirement. If you look at right here, the red arrow is showing you how much you could potentially receive once you reach your full retirement age. For the majority of the people, is 67 years old. It varies depending on the year that you were born. So it's not exactly 67 years on your birthday when you turn 67. It can be 67 in 3 months, or something like that. It depends, but that's for most people it's just 67. So it will show you how much you could potentially receive once you retire. And right here at the bottom, if you see this little button right here, you can move it around. So you can move it down to 68 or in between, like to 65, and it will show you how much you will receive. This number right here, when the not the IRS, when the Social Security gives you an estimate of how much you could potentially receive when you retire, they're going to assume that you're going to retire at 67 years old. If you decide to retire earlier, which you're allowed to, by the way, you can retire as early as 62. So if you decide to retire at 62, then your check is gonna be lower. It's gonna be 25% less than what the Social Security originally told you. And this example is $970 per month when you retire at 67, but you decide to retire early, you're only getting 677. In a way, they penalize you for retiring early, but that's the way the system is designed. And the opposite is true. If you decide to delay your retirement, your actual check would increase up to 30%. So in this example right here, instead of retiring at 67, where you could potentially receive $970 per month, you decide to retire at 70, and at that point you will receive a check in the amount of 1,203. This number right here on the top, it changes over time, especially in this particular example that we're using right here. This screen actually belongs to a person who is under 40s, so they still have a long time to go. So this number right here, it will increase over time. The national average is 1,500. That's the national average for Social Security retirement. Here in California, well, it barely, the average that I've seen is around 1,200 for most people. But again, this number right here, it completely depends on your job history. So the more years you work throughout your life, the higher the paycheck is going to be when you retire. And if you scroll down a little bit further on the screen, you can also see another calculators here that will help you to give you an idea of what you could potentially receive for the other benefits. This one right here in particular is about disability benefits. If you can no longer work due through a physical disability or any type of illness, this example right here, this person could potentially receive up to 1,114 per month when they apply for disability benefits. And also it does makes mention about the Medicare part as well. And right here at the bottom, it also mentions the other type of benefit, and it's called the benefits for your former spouse. What that means is that, let's assume that you're currently that you're divorced from your ex spouse, but the rule, special rules within the Social Security Administration says that if your ex spouse, if they earn enough credits, um, the 40 being the minimum, um, and you were married to them for at least 10 years, then you can apply for Social Security retirement based on their earnings. So if you have reached or nearly the retirement age, and if you don't have enough credits of your own, if you were married to somebody who for at least 10 years who did earn the 40 credits, you can receive a retirement check based after your excess uh, work history. The way it works is like you could get 50% of what they receive. For example, once your ex retires, if they receive a $1,000 check in retirement, you qualify to receive a check in the amount of 500. So that's an alternative for those of you who are near the retirement age and who haven't accumulated enough credits throughout their life. So I mean, it's not a lot, but at least it's something there for you. Okay. This is right there, some of my business information. If you have any additional questions regarding the retirement itself or about IHSS, how to report your IHSS wages, you can always just reach out to me. I believe they're gonna distribute this PowerPoint presentation to all of you who attended this webinar. So this information is gonna be there available for you as well. Any questions regarding the Social Security part? Let me go back to the.
You have a
Leave it there
question,
for the
please
6th.
raise your hand and we can unmute you. It looks like you were so thorough, Eduardo. Nobody has any questions. I've learned
Yes.
so much, and I don't get IHSS and I need to apply. So you really clarified a lot of questions I had going in.
Yeah, and personally, I have never received IHSS either. So, but I do have many. I do know a lot of people. I even before I started, getting into the whole tax part of the IHSS. I knew a lot of people who were this with this program, and actually it was because of them, of my close friends, that I actually learned about all the rules, and that's how I became a more proficient in this area.
You know, it's very useful information to ask your own bookkeeper or accountant going before you file your taxes if they know or are proficient in this.
Yes, that's a must. You need to ask him before you even handle them your all of your documents. You need to know that they're qualified to file your tax returns. Unfortunately for you folks, again, you have special regulations that does benefit you in some way, but as you saw already, it does have drawbacks. But you want to avoid, any further problems, especially with the IRS. The IRS is one of the most powerful agencies in the country.
Mhm.
So if you messed up with them, they will come after you, and they will find you. Trust me, they will.
And now,
So,
I did have a question. If IHSS is not your only source of income,
Mhm.
do you feel it is better just to be on the safe side to go ahead and allow them to take taxes out, even though you're going to get it at the end, just to really cover all your bases?
well, I think let me explain a little bit more in regards to your questions. I think what you mean is like, if your if on your second job, your regular job, um, I think well, let me simplify because I was gonna do a lot of a long explanation, but yeah, I mean, you don't necessarily have to request having federal taxes or state taxes with withholdings from your IHSS income. Um, it doesn't really matter because especially if you have dependents, because if you have dependents, if you haven't paid enough taxes on your other job, those credits are going to take care of any deficiencies in taxes. So I know I mentioned that it was a totally personal choice whether to have tax withholdings from your paycheck or not. But in most cases, even if you don't have any withholdings, it doesn't really no, affect you to a great extent when you file a tax returns. Because again, most of you service providers, even if you have mixed income, the great majority of my clients, they don't end up paying any taxes at all. Again, most of them still get a refund. The worst case scenarios for a lot of them has been that their tax return is pretty much just zero refund. Um, so again, just based off of experience, even if you have a second source of income, you will still get a refund. That's true for over 95% of my clients.
Okay, wonderful. Thank you. I'm always paranoid about having to pay.
So I have a question if no one else has a question. So I do receive IHSS and I am exempt for the last 2 years. Last year I didn't receive a W-2. This year I did, but the amount, it's not like the total gross doesn't match with my last pay stub for December, which is December
Yes.
1st through the 15th.
Yes.
So I want to know, should I take my pay stub instead of the W-2? Because it just, the amount is so much like different.
Well, in this case, and I seen it more this year than last year. I don't know what's going on inside with the IHSS agency. They're going crazy because so many of my clients who in the past weren't receiving a W-2, all of a sudden they just start receiving it. And those who were receiving it in the past, they just start receiving it completely. I don't know what's going on in there. That's something internally. And yeah, what you're mentioning right now is that you receive a partial W-2. So the way it will work for you, you need to report the W-2 as it is.
Okay.
And additionally, you need to do a second entry where you input the difference. So in other words, you're gonna look at the total amount that you had in your paycheck, the total amount for the year. You're gonna subtract that from whatever amounts reported on the W-2, and that's gonna be your second entry. So you wanna reflect the entire amount because also that's the rule for the IRS. Because if technically the W-2 that you receive, it's a partial. You cannot report partial IHSS wages because in many ways, if you report it partially, that will put you within a credit zone. Um, for example, just a quick example, if you're like single with one or two dependents, your threshold for the earned income credit is a little bit below, it's 48,000. So if you earn 50,000 in IHS wages, you're pretty much out of the credit. You don't receive it. But if you receive a partial W-2 that shows only 10,000, for example, and if you only report the 10,000, that will put you within the zone to receive the earned income credit. But the IRS doesn't allow that. You have to report the full amount, even if the W-2 reflects a partial, just a portion of your total or your total wages. So you just gotta watch out for that. You have to do double entry in your tax return.
Okay, thank you so much.
Mhm.
Eduardo, can you put your contact information slide back up
Oh,
so we
yes.
can let everybody see it one more time?
Right there.
Thank you.
So that's my phone number. That's
Perfect.
my email. I think the best way to reach out to me at this moment is by email. If you do call me, there's a high probability that I may not answer you at the moment, I do try to get back to you. My goal is within 24 hours to get back to you, but the easiest way is by email, because even sometimes late at night, I'm looking at my emails, I'm responding to them. So it will be a little bit faster if you send me an email. So yeah, just because of the time that we're going through, it's tax season. It's still the peak, excuse me, it's still peak time for tax season. So yes, I'm super busy at the moment. So just be a little bit patient with me, but I will get back to you as soon as possible.
Wonderful. We understand, and thank you so much for making time for these important workshops last week in Spanish and today in English. So we really appreciate it.
No, thank you
Thank you so
very much for the invitation, and